Welcome back to the Wealth Twins channel. Most investing for beginner advice videos just tell you what mistakes to avoid when you're just beginning trading in the stock market. But in this video, we will not only tell you what mistakes to be on the lookout for, but our advice on how to avoid them in the first place.
Yep, we both have over 20 years of investing experience, and we're going to break down our advice to you in this video. Sound good? All right, let's get it. Jumping right into number one. Don't buy trades at the market order.
Yep.
That means paying the price that someone else sets for you, and it is not in your best interest. All right? Market orders are for suckers.
Whoa. Say that again.
Suckers pay full price when you know you can get something on sale. I'm just saying.
Wow.
All right? Not to be cruel, but you need to negotiate your price. Book your trades as a limit order instead, okay? A limit order is when you set the price that you're willing to pay. It's just a few more steps, but it will save you money in the long run.
Mm-hmm.
We love saving money, and every penny that you save goes to you growing your wealth.
Yep.
If the stock is liquid enough, you will most likely get it at the price you want.
So you're saying you don't have to put in a market order to get the stock that you want?
Yeah, you can't go too low below the market price, but if the stock is liquid enough, you will get the price that you choose.
Because just like you want to buy, someone else wants to sell.
Yep. So now as an investing beginner, you might not know that the market order is what's listed under ask. However, that's the one that you don't want. Let's look at how easy it is to put in a limit order on Fidelity and how a few more steps can save you money.
Yep.
So right now we're going to show you how to turn a market order to a limit order. We're buying SPY. Right now, the price says it's $316.90. I don't want to pay that price. So I put in a quantity of 1 share. The order type I'm selecting is limit order, not market order. And then I'm going to put my price. So if I want to buy this and make sure my trade is hit, I'm going to put it at $316 and say 75 cents. Okay? And that's what you should do when you're buying your trades. You just make it a little lower than the market price to make sure you get it and not pay full price.
If you would like to learn more about the different types of orders that you can use when booking trades, check out our other video, which we talk about all about the different types of market orders.
Yep.
Now, another investing mistake that beginners usually make and what we want you to avoid is focusing only on price.
Only on price.
Yep. How many people, and I know you're included with this, how many people have you heard talk about the price of Tesla and the price of Amazon, how they got these, these deals on it. They only bought it at $200 and now they're like $1,100, $1,900, and they're telling you how great they are. Well, guess what? Unless they are selling these stocks,
okay,
the price of the stock does not matter. It does not matter what you bought them at. If you don't sell, you can't get the money for them. On top of that, these stocks do not pay a dividend.
So what you're basically telling me is this is just paper money.
It's just paper money.
It can just disappear.
Yes. Now, unless
you sell it.
Exactly, because all you have right now is bragging rights. You want stocks that are paying a dividend, because a dividend stock, if you're holding it and it goes up, you get two things. One, you get the dividend, which will allow you just to make passive income just by holding the stock.
Just by holding it.
Okay, I said passive income just for holding the stock.
That's the only way you make passive income in the stock market.
And two, if the price goes up and you bought it at a low price, then you get the price appreciation for it. So that's two things that you can get for buying a dividend stock. So just buying a stock that doesn't pay a dividend, but you got it at a low price and now it's high, it don't mean anything until you are selling it. Okay?
Right. So what should they do, Nicole?
One, like I mentioned, focus on something other than price. You want to get one at a good price that you believe is going to go up, but you also want to see if the stock that you're buying will pay dividends. Okay, that's an extra. And it also changes you from a speculator into an investor of a company where you're more concerned about what that company is doing. And you get paid just for holding the stock.
You're more like an owner in that aspect.
Now, if you choose not to buy a dividend stock, the next thing we want you to do to avoid that mistake of just running, telling everybody your business and then focusing on price, we want you to make a plan so that you can actually benefit from that price increase. Make a price that you want to sell it at so that you can reap some of that benefits. I'm not telling you to sell all of your stock if you don't want to, but take some of that stock and sell it when the price goes way up so that you can reap some of the benefits.
Yeah. If you're picking up what we're putting down, type gems in the comments.
Gems. So, that is the second mistake that we want to talk about and that a lot of people don't know. Now, if you don't know what dividends are and then you're investing beginner and you want to learn about dividends, we want to tell you that we also have a video about dividend investing. We also have one that tells you exactly what a dividend is. So check those out too.
Yeah, they'll be in the description and they'll also be in the cards, okay?
Yep.
Our next piece of advice is paying high fees. Fees are a killer when it comes to investing. They will rob you of your future.
Ooh.
Please pay attention to how much you're paying with these fees, all right? Look out for the fees on the securities that you buy and figure out if that fee is worth paying for. For instance, if you buy a mutual fund, you can easily check what the expense ratio is. It's listed there. Most mutual funds, exchange-traded funds, or index funds, they charge a fee to run the fund. But it doesn't mean you need to pay for the ones that are also paying a portfolio manager to lose money that you can manage better yourself.
Wow.
All right? So make sure if a fund is charging a fee, make sure it's worth it. Does it have a good track record? How does it compare to the other funds in the same category, right? The higher the fees, the more your investment has to make just to break even. Plus, these fees rack up over time and lower your return. Instead of getting compound interest, you're getting hit with compound fees.
Ooh, that's a nice one.
Compound fees.
Compound fees.
I'm breaking it down for you, all right? If you're buying a fund and you want to see if what the fees are being charged, just call your broker up, or you can find it by yourself, right?
Now, we're going to show you how you can easily find the expense ratio of a fund on Yahoo Finance.
You can find this anywhere. Okay, guys? It's easy. We're going to show you right now.
Okay, guys, we're on Yahoo Finance, which is the website we're going to use to easily find the expense ratio of a fund. The fund we're going to use is SPY, which we used earlier. You first type in the ticker, SPY. Press enter. And then all you have to do is scroll down to see the summary of the fund. And right here, you have the expense ratio.
All right. If you want to narrow down your search for low-cost funds, Vanguard is famous for their low-cost funds, and Fidelity actually has a line of zero funds that have no expense ratio, and they have no minimums to invest. That means you can buy one of their zero funds for as low as $1.
Yep.
Okay? Another fee I want you guys to look out for is when you're booking your trades. Don't just go for a broker that you're used to going to and you don't know that there are other brokers who do similar things but don't charge a fee for you to book your original trade. You need to find a platform that's easy to use, gives you the option to book the trades on your computer or on your phone, and charges you no fees. Okay? Everything's free right now. They're vying for your business. It used to be $7.95. When we were first trading, it was like $50 to talk to somebody on the phone. Yep. Or $25 to book it yourself. Now it's $0.
So it's actually a benefit to be investing as a beginner right now because you're paying less in fees.
Yeah, and you can learn along the way.
Now, the next investing mistake for beginners that we want to talk about is you need to really understand your risk tolerance.
Yeah.
A lot of people make the mistake and don't understand what their true risk tolerance is, okay? Think about it this way. It's very easy when you buy a stock and you say, okay, I got it at a good price, and you're hoping that the stock price goes up.
Yeah.
And you're not minding, you have a high risk tolerance, you think, and you say, okay, this stock is a little risky, but I believe this stock is going to go up. Now, how risky are you? Say the market is going down and that stock price is going down with it. Are you committed to that stock?
Or are you going to get scared?
Are you going to get scared, right? Now, if you didn't do your research before and you don't know anything other than the price of that stock and the hope that it was going to go up, I can tell you your risk tolerance will change.
It will change.
You will sell very quickly. Now, most people try to do the whole thing. I'm sure you heard of this. They want you to buy low and sell high. But if you don't understand your risk tolerance for real, you will buy high and sell low.
Yep.
That is the original problem. That's what people do all the time. That's one of the biggest mistakes because people don't understand their risk tolerance and how emotional they can be when the market is going down.
And this happens more times than you would
probably even realize. You can go in initially thinking, oh, I have this covered. I can stomach this kind of
Don't worry, I'm 20-something years old. I can accept all the risks in the world.
More people buy high and then sell low, okay? Because they jump out at the wrong time.
Yeah, they don't understand the risk
So what
tolerance.
should they do, Nicole?
Now, to avoid this, I want you to research the stock using historical data and also looking at their quarterly reports.
All of this is public.
Yes, you need to understand the earnings and the cash flows of the company, even what the debt looks like, right? Because you want to know what is really going on inside that company and how they're going to face some of these challenges.
Well, let's take a step back. When she's saying their debt, their earnings, and their cash flow, you want to know how much money is coming into this company and how much do they owe.
Yep. And then on top of that, you want to know what real value does this company actually have that makes it unique and make them going to be one of those companies that's going to last and actually make a profit in the future.
Yeah.
You want to research these things outside of just the price so that you know what to do.
Yeah, this will stop you from being emotional and allow you to hold your guns and only trade when things in the company changes, not when the market changes on you.
Yep. Remember that point.
All right. Next one. Taking advice from other people without doing your own research.
Oh, Nadi likes this one, huh?
All right. I've been investing for years and I thought I was past this, but I just did it recently and I know better, but it's just so tempting.
So what are you saying? This is not just an investing beginner mistake?
No, anybody can fall for it.
You know why? Because gambling is addictive.
And that's exactly what you're doing when you're not doing your research and you're taking somebody's advice. Every time I take someone's advice without doing my research and I move too quick, I lose money.
Now,
Every single time.
can I give them something I always tell people?
What?
1, people always love to tell you when to buy, but they never tell you when to sell.
Oh.
That is a huge difference, okay? They should tell you, when they tell you what to buy, they should tell you when to sell a stock. And then that will be some decent advice, I guess.
Other than that, don't take the advice of someone and say, oh, this price is good right now, jump in on it. Do your own research.
Because when the price is too good, it's usually too good, and you're gambling.
You're gambling.
Yeah.
Right.
And more times than not, it doesn't turn out well, right?
And how do you avoid this?
Don't take advice from people when it comes to buying stocks that you didn't research.
Trust yourself.
Yes.
All right. Next one, taxes. A lot of people avoid this, okay? But if you are a beginning investor, you may not know that if you sell an investment that you had for less than a year and you sell that for a profit, you're going to pay something called a capital gains tax. This is going to be taxed at the same rate as your regular income, all right? Now, the best thing for you to do if you're looking for long-term growth and you're trying to make money in the market is to hold your investment for over a year. If you make a profit on that, then you may have to pay a long-term capital gains tax. This depends on how much you make a year. If you make under $40,000 as an individual, under like around $78,000 as a couple, you won't pay taxes on it, which is great. The money you make, you take out of the market, that's your money. If you make more than $40,000 as an individual, but less than $430,000, which is a lot of people, then you're going to be taxed at 15%, right? Anybody who makes over $430,000 are going to be taxed at a 20% tax rate.
Yeah, so, fees will take away from your wealth, but so will taxes.
Yeah, we're trying to grow our money here. We're not trying to pay it away to people.
So what should you do?
Hold it for more than a year or at least a year so you can benefit from the gains and not get taxed on it as income.
Now, the next investing beginning mistake, and I would say a mistake for a lot of people that even prevents them from investing in the first place, is staying out of the market because you think you don't have enough money.
And this cuts across all ages and all people.
Or because you're scared. And what do we say?
Scared money don't make money.
Scared money don't make money, but it has to be smart money, right?
Yeah.
Now, I will tell you, the longer you stay out of the stock market, the longer you are missing out on the compound interest that the market can provide.
Yep.
Okay? Not having a lot of money should not stop you from investing. You can now invest in good companies with as little as $1 through something called fractional shares or stock slicing.
Yeah.
If you want to know more information about stock slices, you can also check out our video that we will leave in the description.
And up here. All right. So another thing that we see a lot of beginners do when they're beginning investing, and our advice to you, is make sure you keep it simple.
Keep
okay?
it simple.
A lot of people are not keeping it simple when they start investing. This is my personal opinion, but I'm sure Nicole might agree with this, and it may be unpopular. I don't care. I'm going to tell it to you. You shouldn't be in anything like options, Forex, or any kind of derivative trading if you are a new investor. All right? Whether you're a beginner or a vet, understanding what you're investing in and why you're investing in it is vital to your success in the stock market. If you're new to the stock market and you're chasing quick money, then you're most likely going to be in more risky investments.
And we're trying to invest for the long term here. We're trying to get you to make passive income. We're trying to get you to build your wealth.
Yeah. These kind of risky investments can shift one way or the other. If it goes against you, money still has to be paid, right? The piper still has to be paid. You will owe a lot of money if the market goes opposite of what you thought you were doing, right? Stick to simple investments. Have a plan, and make it simple when you're starting out. There's plenty of time to go to more risky investments, but learn the basics. You have to crawl before you walk. Don't start running.
So if you like what Nadi just told you, put KISS down in the comments, right? Keep it simple.
Keep it simple, sisters.
Sister. Exactly, twin sisters. That's a good one. I like that.
So if you guys like the points we made today, just understand they're based on our experience, all right? If there's anything in regards to avoiding these mistakes when you're a beginner investor that you want us to address further, or in another investment related video you would like to see here, make sure you leave it in the comments.
We want to help you to avoid the mistakes that we've made when we were investing as beginners. We don't want you to do the same thing. So if we can cut out half that time and half the mistakes, that would be great for us to help you.
Yeah, and we don't want you to lose money either, all right? Don't let the amount of information in the stock market stop you from beginning to invest. We're here for you, so hit us up. We respond to every comment.
Every comment.
Yeah, it's either me or Nicole, but you're going to get one of us, all right?
And if you like this video, make sure you share with others who can use the same information. We want to see you guys win.
Until then, remember, your manners will always take you further than your money.
See you in the next video, guys.
See you in the next video.